Hi there, I'm Skip Reynolds with Skipton Law, Estate Planning and Elder Law in Centennial, Colorado. And today I want to talk to you some about gifting, because there's all kinds of things regarding gifting of money and or assets that are big questions that come up in my office all the time. And I want to go through these things and describe some of the considerations that people should make or think about before they make such a big decision to make a gift of any asset, so that they don't run afoul of all kinds of different things that you may not have even ever thought about. So what I'm going to do is I want to kind of break this down. And my first thing that I want to say is when we make a gift to someone, we can't get it back. In a non-legal sense, it is non-take-abackable, meaning unless they want to give it back to us, it's theirs. We gave it away, whether it's cash, whether it's an asset, whether it's our house, whatever it is. We gave it away. We gave up control over it. And so there's some things to think about when making any kind of gift. And then we're going to get into different types of gifts with assets as to considerations that are really big to consider. But when you make a gift and you make it non-take-abackable, as I said, you no longer have control over it, right? Because you gave it away. So whatever it is that you gave, whether it's that cash or whether it's an asset like a vehicle, or that maybe we put our child on our house with us, that's a common gift. You gave up some level of control, because now, even if you have a co-ownership, you don't have 100% control. Someone else also has a say in what goes on. And sometimes when we do this, we aren't thinking of that. We're just thinking of an end repercussion. And the most common repercussion that we think of, or that I hear of in my office, is I want to avoid probate, or I don't want the nursing home to take it, so I'm going to give it away. And those are okay things to be thinking of and reasons to potentially make a gift, but they are just one part of this entire story. So let me give you an example. When you give something away and you give it away non-take-abackable, you lose that level of control, right? And so when you give it to someone and you lose this control, and a common asset that people give away, especially as we age, is our real estate, because we've been told, or we heard, or we had this done by our parents to us, to give our property to our kids. So you give it away to your kid, and let's just say you own it in co-ownership. And now at some later date, you want and or need to sell that property. Guess who's involved in the sale of that property? Yep, you guessed it. It's that individual that you put on the property title with you, right? And so if my parents put me on with them, I now have a say in whether they sell their property or not. Now, you may be sitting there and you say, oh, my kids will go along with the program. And I hope they do, but that is not always the circumstance. See, because things can change, right? Good intentions today may not be the same as 15 years from now, 20 years from now, 30, 40 years from now. You've got to be aware that relationships can change. Other kinds of considerations could change, in which your gift to this individual now is going to cause you a later issue, because you gave it away non-take-abackable and you gave up some level of control. So control is a big issue when you make a gift. You need to be aware of your loss of control, because whoever you gave it to does not have to follow what you ask them to do. And in a worst case scenario, where are we going to try to fix this problem? Yep, that's right, the courthouse, the place you were trying to avoid in the first place, right? So that's one issue. Another issue is liabilities. So if you make a gift of money, we now have the money in somebody else's account. Maybe they're a co-owner on the account with us, or maybe they're a co-owner of our real estate with us. But what happens if they run afoul? What if they have credit issues or bankruptcy issues, or maybe they have some other accident or something that occurs that is now an issue and a liability problem for them? Whose asset or assets is now at risk? That's right, yours, the person who made the gift. So you gave it away because you were trying to make other things happen. But now the individual you gave it to is having some other issue that wasn't foreseen at the time you made the gift. And now that asset that you gave them is at risk to their liabilities. So if you give away a portion of your house and your kid has a car accident and they're found under the influence of drugs or alcohol and it's their fault and somebody's very injured or even dies, what are they going to do? Well, I'll tell you what they're going to do. They're going to go after the insurance company, and if the insurance isn't enough, they're going to come after the individual. Well, the individual has assets, and one of those assets is the asset that was gifted away. So now the asset that was gifted away to avoid probate or avoid the nursing home, bang, now potentially subject to the liabilities of this other person. Not foreseen, maybe been 5 years, 10 years, 15 years, nothing has happened, and then boom, something changed. It's hard to foresee all of this. Now, is this a huge risk? Maybe yes, maybe no, all depends. We actually had one here in my office just recently that 5 years ago, unforeseen, now it's a reality, and the liabilities could potentially be a big issue. But we made these gifts more than 5 years ago, before talking to anybody, before trying to fix the problem, and now we've got a problem, and we really can't fix it. So liabilities is another one. And then another one could be taxes, right? So there are various forms of gift taxes, but there's other taxes involved in gifting as well. So one part of gifting is the annual gift tax. And I've talked about this in shorter vlogs such as this. You can, in the year 2021, give away to whomever you want $15,000 to whomever you want. So in theory, if I wanted to give everybody in my neighborhood $15,000, I could give each one of them 15,000. Here's 15, here's 15, here's 15. No tax ramification. I don't even have to tell the IRS. And if I'm married, in theory, my wife could also give those same people $15,000. So if I had enough money, everybody in my neighborhood could get $30,000 from myself and my wife, 15 from each of us. And I would not even have to tell the IRS that I made such gifts, especially if they're in the form of cash. But that's the annual piece. But there's also a lifetime piece here, where you can, in the year 2021, give away up to $11.7 million without incurring any federal gift tax consequence. Now, there may be other taxes, and I'll talk about that here in a couple minutes, but no gift tax consequences. So here's an example of how it works. So let's just say that I want to give somebody $200,000. I give them 15, my wife gives them 15, we gave them 30 under the annual 15,000 amount. The remaining 170 we must notify the IRS about. And all they're going to do is they're going to deduct that 170, or at least my share of the 170, from my $11.7 million I can give during my entire lifetime. So they're going to deduct 170 in theory from my lifetime gifting amount. But at the same time, they're also going to take away 170,000 from what I can die with the estate tax that is also 11.7 million. All the IRS really wants to do with these larger gifts is track them to ensure that you don't give away more than your lifetime allowance. That's all they're trying to do. Now, if you're a wealthy individual, you may be using these rules for tax advantages. But for many people that are not, I'll call it ultra wealthy, if you don't have more than $11.7 million, in theory, do not do it. Please, please, please do not do it without any advice. In theory, you can gift away your entire estate. And the reason that you could do that is because if you're under the current amount of this year, there is no gift tax consequence because all they're going to do is calculate it. So if you have a $700,000 estate, you could give all $700,000 away. In theory, don't do it again, but you could. And they're just going to deduct from your lifetime amounts of gifting or your death amount of your estate tax. Pretty straightforward. But there's some other consequences to think about when you make gifts in the form of taxes. See, when you give somebody cash, regardless of the amount, 15,000, under 15,000, more than 15,000, that money has already been taxed. You've paid the tax at some point prior to making the gift. But let's say it's a stock and you bought the stock for $10 a share and now it's worth $100 a share. When you give it to the individual, there is no tax at that time because you gave it to the individual. But here's what the IRS says. The IRS looks at that and says, you know what? You never paid on that capital gain, the 10 to 100. So therefore, we're going to assume that the person who you gave it to also, it's like they bought it with you at $10 a share. So when they go to sell it at a later time, during and or life or after your life, they are going to owe capital gains taxes on that transfer, all the way back to the number in which it was worth when you bought it. A lot of people want it to be a higher number. Oh, it's the value when you got it. The IRS has the ability to go all the way back down to the original number if it's trackable, right? So you gave it away. There's no initial tax consequence, but if it's sold at a later date, there could be a capital gain tax consequence for that gift. That's a stock. Real estate, under the current tax laws, acts very similar. You bought it for $100,000. It's now worth $400,000, and you want to give it away. Okay, great. You can give it away. But when you give it away, the IRS has the capability, if they choose to take it all the way back down to 100. So when that house is sold during or after your life by whoever you gave it to, they're incurring a capital gain cost for that sale. Now, there might be some other nuances involved there, such as what if they're living in it and they meet the residence rules and other kinds of things under the current tax law where they might be able to get around some of that. But generally speaking, when we give away a portion of our house or our entire house, we are still living there. And our children or whoever we gave it to, generally speaking, not always, are not living there. And for them to try to claim this as their personal residence is not going to work. So what could happen in a worst case scenario is you bought it for 100, it's worth 400. This is just an easy example for numbers' sake. The house is sold during or after your life. And let's say that the person you gave it to is in a high tax bracket, high income earner. So they're in a 20% capital gains rate. If they're in a 20% capital gains rate, the cost of you giving that money to that asset to them, if it's a $300,000 capital gain, like in my example, could be up to $60,000 for making that gift. So why do people give money away? Well, they give their assets away to avoid probate. Oh, I've heard probate is awful. Or, hey, I had a great experience. We avoided probate. It was so easy. You should give your house away. So we give away this asset over here to achieve a result over here so it's not in our estate. But then we get caught potentially in a tax purgatory where we're going to owe more in taxes and give more to Uncle Sam than maybe we had thought or intended at all. Whereas under the current tax laws, now subject to change, and there's been some discussion regarding this, and I've talked a little bit about it in previous vlogs such as this. If you give away this money, or you give away this house, excuse me, in theory, if you had kept it until you died, under the current tax law here in 2021, subject to change always, there is what we call a stepped up basis, meaning now it's as if they bought it from you at your date of death. So all that capital gain that occurred during your lifetime wiped away. And now when they turn around and sell it shortly after your death, because they don't live there and they don't want to maintain it or rent it or whatever, now there may be little to no capital gain tax versus giving it away during our life because we wanted to avoid probate, right? So we We wanted one action to happen, but we incurred a new action that might actually be a more negative action to our estate. $60,000 in my example. That's a pretty high price probate in at least the state of Colorado. So to avoid probate, we were willing to give Uncle Sam, in my example, up to $60,000 to avoid that probate. Or what happens if you're giving things away and you're in long-term care and it's been less than 5 years, right? So you gave this away because you didn't want the nursing home to take it. Now you're needing care, and that care need is going up and up and up, and you don't have a whole lot of cash. What are we going to do? Especially if it's given away real estate, because you gave it to that person non-take-a-backable. So in order, if you spend all the way down to qualify for a program like Medicaid, you're doing one of two things. You're begging for forgiveness to the Medicaid office, and hopefully they grant it, or you're more than likely going to actually have to go after that individual you gave it to try to recover it and get it back from them through the judicial process, or at least show Medicaid you're trying to, so that you can get that asset back. Now it's not considered a gift anymore, but guess what you have? Oh yeah, you have an asset. You have an asset that's counted against your eligibility for Medicaid. So you gave it away to achieve a result over in avoidance of probate, or to get it out of your estate from long-term care, but then you end up in that long-term care and now you have an issue. In fact, we have somebody right there, right now, that has this problem, but they also have the liability problem that I talked about earlier, because one of the people that they gave it to is now having some legal issues. And those legal issues could cause that portion of that asset to have a lien against it and be lost in the value of this individual's estate because it was given away to avoid probate. And they couldn't get it back because it was non-take-a-backable. So all of this is just to talk about, hey, I'm not telling you don't make gifts. Sometimes gifts make sense, but be aware of the different things and that you need to talk to a professional before you make a large decision, such as giving away your house, because there may be things that you're not even considering that could be a negative effect worse than the positive effect you're trying to gain. And there might be other alternative ways to accomplish your end result without some of these other negative consequences. But if you don't know, how do you ever make that right choice? I'm all about choices. So if you like this video, you can find more videos like this on our YouTube channel, Skipped in Law, or you can go to our website where I do twice monthly educational workshops here in Colorado discussing all sorts of topics: powers of attorney, wills, trusts, Medicaid planning, asset preservation planning, all of these things. If you'd like to sign up, you can go to our website at skippedinlaw.com. You can click on the workshop tab and sign up there, or you can call our office at 720-440-2774. We'd be happy to see you at one of those workshops. And I want to thank you for watching this blog and look for more coming in the future.